Welcome back to the channel, guys. Now, I'm sure that you're all aware of the recent tweet from President Trump talking about the trade talks with China, saying that they're progressing too slowly, so he will be increasing tariffs to 25% on those Chinese goods being imported into the US. Obviously, this is the complete opposite of what we were expecting. I think we can all agree that the market has probably priced in a trade deal with China already. So this can absolutely have a very negative impact on the stock market, especially on Chinese stocks, which we all know the Chinese economy is going through issues of its own, going through an overall economic slowdown for quite a while now. So I thought it'd be fun today to take a proactive approach and take a look at 5 of my favorite Chinese stocks that could very well struggle throughout this year if the whole trade fight continues, and we could definitely see some lower nicer prices, some lower valuations, and some great prices on some really good companies. So make sure you hit the like button if you enjoy this, and let me know in the comment section if you'd like me to do this for some US stocks as well that could also be very negatively impacted by the whole trade fight. I definitely have some in mind, and I think that would be a fun video as well. But with that said, let's go ahead and start with stock number 1. Now, these stocks are in no particular order. Stock number 1 happens to be my favorite and the only one that I'm actually invested in. But stock number 5 is also my second favorite. It's one that I really want to invest in. So there's really just no order to this. But anyway, starting with stock number 1, we've got Alibaba. Ticker symbol BABA. Now, as far as their business goes, they're basically the biggest e-commerce company in China, but they're also pretty well diversified in that they are involved in business to consumer operations like Amazon through their Tmall platform, but also consumer to consumer, kind of like eBay through their Taobao platform, and even business to business through their Alibaba.com platform, which, by the way, many US companies actually buy products that are manufactured in China through Alibaba and then sell them in the US for a premium, and sometimes even on Amazon itself, which is kind of funny. But as if this wasn't enough, they are also heavily involved in traditional retail with what they refer to as new retail. They have their own artificial intelligence division that is building robots and processing chips, and they even have an enormous cloud computing platform that grew sales last quarter by a massive 84% year over year. Now, so far on Monday, which by the way, that's when I'm recording this video, it's still down over 4% due to the negative trade talk, but it was actually down more at over 5% in early trading. You'll see a common trend of this throughout the video because many Chinese stocks were down huge earlier today, but they later recovered throughout the day for some reason. However, this is also coming off of phenomenal performance this year, which it has surged by over 36% in 2019 alone. Of course, that's also coming off of horrible performance at the end of last year, where it dropped by close to 40% as the broader market was experiencing a major correction and China was also in crisis mode. In any case, Alibaba remains one of the best performing companies in the world, having grown their sales from $12.3 billion in 2015 to about $40 billion in 2018. That's an increase of over 230% in just a few years. And if you think that's crazy, in their last quarter, they grew sales by over 40% and generated over $17 billion of revenue. That's more than half the revenue that they generated in the entire fiscal 2018 year. By the way, they end their fiscal year like in March, I believe, so it's a little tricky. But anyway, not to mention that they've even become more profitable as well, having grown free cash flow by double digits at around 10.7% in their last quarter to as much as $7.5 billion US dollars. Now, their valuation is still pretty high with a forward PE ratio of over 27, so I'd like to wait for a bigger drop if I can get it throughout this year. But either way, I gotta figure that once the trade deal gets done, Chinese consumer confidence goes up and China's economy returns to higher growth, my opinion is that Alibaba is going to be an even bigger giant over the long term, and that's why I'm buying the stock on any real big dips or crashes. Alright guys, moving on to stock number 2, we'll stick with the whole e-commerce theme and go with JD.com. Now, I personally do not own any JD stock myself because I'd rather put the money into Alibaba, but it still remains a very high growth company with a ton of potential. Also, JD is much more focused on business to consumer operations, which has led to many people calling this the real Amazon of China. Now, one of the crazy things about JD that I don't think a lot of people even realize is that they actually generate more revenue than Alibaba. That usually shocks people because Alibaba's market cap is hundreds of billions of dollars larger than JD, but if we look at the past 4 years, JD actually grew their sales from $27.9 billion in 2015 to more than double that amount at $67.3 billion in 2018. However, when looking at their profits, their numbers are nowhere near the levels of Alibaba. See, Alibaba is profitable by billions of dollars, but JD has seen negative net income for years now, and those numbers have been kind of all over the place, although non-GAAP net income was at least positive last year by around $500 million. Still, this is a company that has built up their website and supply chain to be one of the most advanced e-commerce platforms in the world, using a combination of robots, artificial intelligence, big data, and machine learning to help attract not only just merchants but also advertisers, and to automate their supply chain as much as possible. They even built the world's first automated warehouse in Shanghai and are already developing their own drones and autonomous vehicles to make deliveries even in the hardest to reach areas of China. All of this technology has also helped them deliver over 90% of orders by the same or next day, which is something that they claim no other company can compete with, which has also helped JD attract a number of different companies to actually adopt their logistics system for countrywide delivery that is generating enormous revenue. So they don't necessarily have to just JD kind of sell everything themselves, but they also offer their logistics services to other companies, which is pretty crazy. Not to mention that they've also landed very lucrative deals with Tencent, which gives them exclusive access to the extremely popular WeChat and mobile QQ platforms, and they also partnered with Walmart so that both companies can reach more customers throughout the country. In any case, their stock took a really big hit today. I know it says here that they only dropped by about 4.5%, but if you were paying attention earlier in the day, the stock was actually down by around 10%, so that's a pretty big one-day drop. Still, they're already up over 37% this year alone, and their valuation is pretty rich with a forward PE ratio of over 30, so I gotta figure that if the trade war continues, JD is probably going to have a very bad time. In any case, if you couple their high sales growth with the fast-growing Chinese e-commerce market, then you may end up with a decent stock here. By the way, I used to think that the Chinese e-commerce market was still doing less than $1 trillion, but I'm seeing new reports now that show that the market is growing by over 20% a year and has already broken north of $1.3 trillion last year, which would represent around 25% of all of their retail combined, which, by the way, is also growing faster than the US and will soon break ahead as the largest retail market in the world at around $5.6 trillion. That is massive. For context, the global e-commerce market is expected to do around $3.5 trillion in sales this year, so China would easily make up more than a third of that. And who stands to benefit the most? Well, I would argue that the biggest players in that Chinese market will, like Alibaba, who controls 53% market share, and JD.com at 16% market share. By the way, JD's share actually increases to almost 25% if you look at just business to consumer, which is really kind of the specialty of JD. Also, I believe JD is reporting earnings on Friday, so make sure you keep an eye on that because if they come out with bad earnings, then you could possibly see a really big drop in the share price, even bigger than what we're already seeing. Alright guys, moving on to stock number 3, I'll actually give you a little bit of an indirect play on the Chinese e-commerce market, and that's going to be BIDU, ticker symbol BZUN. Now, I did just recently talk about this one in my 3 stocks for May video, but just a quick refresher, this isn't actually a competitor to something like Alibaba or JD.com. Instead, they help businesses and brands set up online shopping sites, which are many times actually on Alibaba and JD's platforms. In fact, Alibaba actually owns about 16% of the company. So where Alibaba and JD are often considered the Amazon and eBay of China, BIDU would be more like the Shopify of China. By offering IT solutions and services, help with store operations, digital marketing, customer services, warehousing, and even fulfillment, BIDU is able to attract many big companies to hire them for their services. A big example of this is when they helped Microsoft set up their shop on Tencent's popular WeChat mobile application. In any case, this has led to tremendous growth for the company, as their sales have now climbed from $400 million in 2015 to $786 million in 2018, representing growth of 22% in 2016, 30% in 2017, 23% in 2018, and a compound annual growth rate of over 25%. So those are very nice growth rates. Profits have also been equally impressive, with net income climbing from just 3.5 million in 2015 to almost 40 million by last year. That represents growth of over 250% in 2016, over 150% in 2017, and still over 22% in 2018, with a compound annual growth rate of over 120%. Still, their valuation isn't exactly cheap, with a trailing PE ratio of almost 80, but their forward PE does improve all the way down to 20, and their stock got even cheaper today as it dropped by very close to 10% before recovering to only be down by less than 6%. Still, this is a stock that is up by over 57% this year alone, but is still down by over 30% from their 52-week high. So I do think that there's still a ton of upside potential left for this stock if the company can execute over the long term, and especially if we get a lower price on weaker, macroeconomic conditions. All right, guys, and that brings us to stock number 4, and here we're gonna go with BIDU, ticker symbol BIDU, and they've been referred to as the sort of Google of China because they're essentially a Chinese language internet search provider, commanding over 65% of the desktop search market and over 71% of the mobile search market, making them by far the biggest player in the whole market. This has led to their sales growing from around 10 billion in 2015 to almost $15 billion just a few years later. Most of that growth is thanks to their online advertising business, which has plenty of room to keep growing, considering that the market as a whole is estimated to do over $300 billion globally this year, with China alone bringing in nearly $80 billion of that digital ad spending. That represents growth of 22% and accounts for about 70% of total media spending in China. By the way, eMarketer also predicts that Baidu's market share should remain stable throughout their forecast, at least until 2021. However, poor macroeconomic conditions in China, coupled with higher costs, have led to shrinking profits for Baidu. Here's a chart of their net income in the past 4 years, and while it did drop significantly from their 2015 highs, it has thankfully picked back up last year to about $4 billion. Still, if we look at their most recent quarter, adjusted net income actually dropped by 17% year over year. It was still up by 35% for the year, but that doesn't really excuse the most recent drop. To be fair, much of the reason for that is actually due to IQ, which is considered the Netflix of China, and Baidu owns 60% of that company. And the problem is that Baidu saw content costs increase by 96% in the quarter, which they attributed to growing investments in IQ's content, similar to what Netflix does here in the US. In any case, the stock has been beaten up as a result. Keep in mind that many popular Chinese stocks have absolutely soared this year by huge amounts, but Baidu is only up by less than 4% year to date and is still down by over 40% from their 52-week high. The stock was also down over 4% today, but later recovered to only be down by around 1.5%. In any case, the investments in IQ aren't necessarily going to waste, as they contribute to much of Baidu's revenue growth. In fact, IQ added over 36 million subscribers last year to reach a total of 87 million for the year, and they're even projecting to hit 120 million by the end of this year. Keep in mind that Netflix has about 150 million subscribers globally, while IQ is only really focused on China. And because more than 98% of their base are paid subscribers, they've seen sales increase by 55% last quarter and 52% in the year. You also have to keep in mind that Baidu is investing heavily in their future with artificial intelligence, big data, cloud computing, and even autonomous driving through their Project Apollo, which is an open source operating system for driverless vehicles. All of these different areas benefit heavily from the enormous data that Baidu collects from their search engines and their maps platform. So a couple of future growth prospects mixed with a decent valuation of just 14.5 times future earnings, and you've got an interesting stock to watch if China's slowing down economy continues to drag it down further. And finally, that brings us to stock number 5, which is one of my absolute favorites and one that I wish to invest in myself if the stock gets dragged down lower, and that's Tencent, ticker symbol TCEHY. Now, this past year, they are currently down about 12% from their 52-week high, but so far in 2019, they have surged up over 22%, thanks to strong performance. Speaking of which, their sales have now grown from 102 billion yuan in 2015 to a massive 312 billion last year, with year-over-year sales growth in 2018 coming in at over 31%. Profits have also been solid, with net income growing from around 28 billion yuan in 2015 to over 78 billion just a few years later. And if we look at their adjusted earnings, net income actually grew by 21% year over year to over 11.6 billion US dollars. So that's very strong performance overall. Sales from their online advertising business also grew by 38% just in the last quarter, while social networks revenue grew by 25%, and sales from their other businesses segments grew by a massive 72%, which is mostly thanks to their financial technologies and the all-important cloud services. By the way, their advertising business grew by even more for the year at a very impressive 44%. A lot of this growth is thanks to their high-margin online advertising revenue that they generate from a number of different platforms, that many of which actually have over 500 million monthly active users, including QQ at over 800 million, BZUN and WeChat combined to over 1 billion, and smart device users of BZUN at over 530 million. QQ, WeChat, and BZUN are very popular messaging and social networking platforms, while Tenpay, WeChat Pay, and QQ Wallet integrate all kinds of mobile payment and online shopping features. Tenpay is actually the second largest online payment platform in China, but they also have a huge gaming division, which famously owns a 40% stake in Epic Games, who generated $3 billion in profits last year, mostly thanks to the very popular Fortnite game. By the way, Tencent is also famous for their mobile gaming division, which grew their smartphone games revenues by 24% last year. That's a big deal, since the gaming market is growing by huge amounts every year and is expected to reach $180 billion by 2021, with the vast majority of that growth coming from mobile games, which is Tencent's specialty. Not to mention that Tencent is also a sort of Netflix clone in their own right, with Tencent Video growing their subscriber count by 58% last year to a massive 89 million subscriptions. Sure, their valuation may not be the most attractive, with a forward PE ratio of 25, but if macroeconomic conditions tank this stock in the near future, I will definitely be there to scoop up some shares at some really low prices. Anyway, I think that just about does it for the video. Thank you so much for watching. Make sure you leave your thoughts down below. How do you feel about these stocks? Are there any that I left off the list that you would add to it? I'd love to read your thoughts down below. But anyway, thank you for watching. I'll catch you guys in the next video. Take care. Bye-bye.